Hello, everybody, and welcome to part 2 of our lecture on chapter 4. And in part 1, we learned about different types of merchandising companies. And now we're going to move on to our next learning point, which is the operating cycle of a merchandiser. And what I mean by the operating cycle of a merchandiser is kind of like the steps they go through from turning their merchandise inventory into cash. Okay, so the first step in the operating cycle is purchasing the merchandise. Okay, they need to have something on their store shelves to be able to sell. Okay, and we refer to that again as inventory, right? When it's sitting on their shelves like this, that means it is inventory, which is an asset that they can use for future benefit because they have the intent to sell it, and when they sell it, they're going to get the benefit. Okay, so that's step one. Okay, is purchasing the merchandise. Okay. The next step is they're going to sell the merchandise. Okay, they're going to sell it to a customer. And sometimes it'll be for cash immediately, and sometimes it will be what we say on account, which, as we've learned, is when we give our customer some time to pay, okay, whether that's 2 weeks or 30 days or whatever the terms are, we're going to give them some time to pay. And that is referred to as accounts receivable, which is supported by a sales invoice, right? So the sales invoice says, look, I sold you this stuff, you received the inventory, and now, you're promising that you're going to pay me in the future. Okay, so what we've done essentially is we purchased the merchandise and then we've sold it, meaning we exchanged this asset of inventory for a promise to pay. And then the third step of that process is we have to collect the receivable, right? Because it's not enough just to sell it and get the promise. We need to actually collect on that promise. So that's the third step, is collection of the receivables. And once we collect the receivables, then we have cash again. And we can use that cash to then buy more merchandise and sell it and collect, and the cycle continues over and over and over again. That's why I refer to it as the operating cycle. So operating is the normal stuff that a business does. So this type of business, they normally purchase stuff and then sell it and collect it, and so on and so forth, over and over. So that's the operating cycle. Okay, so what that means is that every merchandiser both buys and sells inventory. Okay, so they're both a buyer of inventory when they first purchase it here in step 1, and they're also a seller of that merchandise here in step 2 when they sell it to their customer. So the two main types of transactions that a merchandiser has to deal with are this purchase of inventory and then this sale of inventory. In this lecture, I'm going to teach you those basic journal entries for just a basic purchase and a basic sale without any other more complex stuff. Hopefully you will have read about some of the complex stuff in the chapter, and we're also going to focus on the more complex stuff in class. But I don't intend to go over or teach these basic entries. I'm going to assume that you come to class already knowing a basic purchase entry and a basic sales entry, so that then we can build off of those concepts and the more complex things going forward. So first, let's talk about a basic purchase journal entry. Okay, so in this case, our basic purchase of inventory, here's our description. It says Computer City is a retail store that sells computer equipment to individuals and businesses. On September 1st, Computer City purchased 10 Acer computer monitors from Technology Wholesale for $6,000. Payment is due in 30 days. So now let's do a little bit of transaction analysis. So with the purchase of inventory, what happens is Computer City, and as you can see here, Computer City looks like a retailer, okay, because they have nice display set up, different computers that the customers can come in and test out. The displays look nice. There's not a huge quantity of items, just enough on the store shelves to be enough to serve their customers' needs. And we compare that to Technology Wholesale Corp, where, as you see here, Technology looks like a wholesaler because they're more like a warehouse. You don't see cute displays; you just see kind of these big boxes, and because the when Computer City goes to buy the stuff, they don't need a fancy display. They're not trying to, they just need to buy the stuff. The fancy display where everything kind of looks nice is going to be more like here at the retailer, Computer City. Okay, so this is us, Computer City. And so we need to think about, in this transaction, what are we getting? What are we giving? So we know that we're getting these 10 monitors. So we are purchasing inventory. And in exchange, we're giving a promise to pay. It says that the payment is due in 30 days. So that's how we know it's not cash. We know it's on account or on credit, meaning we're going to pay in the future. So what's happening is we're gaining inventory, and inventory is an asset, so our asset is increasing. And in exchange, we're giving a promise to pay, and a promise to pay means that we're in debt. Now we owe something to Technology, so that means our liability is increasing. So when we go to do our journal entry, we're going to, again, go all through the 4 steps. One is identify the accounts. The accounts are merchandise inventory and accounts payable. We're going to determine the increase or decrease. Well, merchandise inventory is increasing because we're acquiring the inventory. And also our debt accounts payable is increasing. Then we're going to apply the debit and credit rules based on these different account types. Well, merchandise inventory is an asset, and if our asset is increasing, it's a debit. And accounts payable is a liability, and if our liability is increasing, it's a credit. So we go through and we list our debits first because that's how Connect likes it, but in real life you don't have to do that. But we start with our debit is our asset account, which is merchandise inventory, with a debit of $6,000. And then we have our liability, accounts payable, increasing with the credit of $6,000. We have our date, of course, and then the last step is you want to make sure our debits equal our credits. 6,000 equals 6,000. So yes, our journal entry is in good shape. The next step in the accounting cycle is to post that entry to the ledger, which, as you see here, we have our merchandise inventory ledger, and we have our debit here of 6,000. Then here we have our accounts payable ledger and our credit here of 6,000. So that is a basic purchase journal entry. The next basic type of journal entry that merchandisers have to take care of is the sale of inventory and how we record that. So it says here, on September 7th, Computer City sold 2 Acer monitors to Sawa Travel Agency at a sales price of $1,000 each for a total of $2,000. Payment is due in 30 days. Okay. So before we can move on, we need to talk about these terms. Okay? Cost versus price. Now, for you and I, when we're just talking to, our family or our friends, we use those terms interchangeably. Oh, how much did that cost you? Or what was the price of that? And we think they mean the same thing. To us, they do. And it's fine if in your regular language you want to do that. But as we've learned before, accounting has its own language, the language of business. So, in order to be able to speak intelligently about these things, you need to know that in accounting, in business, the terms cost and price mean two different things. Okay? The term cost means the amount you buy inventory for. Okay? Separately is price, which is the amount you sell the inventory for. Now, for you and I, we don't really sell stuff, right? Unless, I guess you could kind of sell something to your friends or sell something at a garage sale or on eBay. I don't know what you do, but the average individual does not sell stuff. But businesses sell stuff. So, hopefully, the amount that they buy something for is less than the amount they sell it for. And it has to be that way because if the amount you buy it for is the amount you sell it for, you're not going to make any money. Okay, there has to be a difference here between the cost and the price. And that is why it is very important that we have two different words for those things. You and I, since we don't really sell stuff, we don't have to worry about it. But for a business that both buys and sells inventory, you have to have different terms for each one. Okay, so this monitor here actually has two different dollar values associated with it. It has the cost, which is what the company bought it for, and it has the price, which is what the company sold it for. Okay, so as you recall, in that first purchase transaction, it says that they bought the monitors from Technology Wholesale Corp for $600. Okay, $600 each. And in fact, you know what? I don't even think the problem specifically said that, but just to refresh your memory and to prove that is the case, it says here that there were 10 monitors for $6,000 total. So if you get out your calculator and do the math, $6,000 divided by 10 monitors comes out to $600 each. Okay, so, and these must be very fancy monitors to cost $600 each, but just, go with it. So that's where the $600 comes from. That is the cost to Computer City, okay, because they bought it for $600. Okay, now in this second transaction, this sales transaction, they're selling them for $1,000 each. Okay, let's go back to the problem here. Now it says the monitors had a sales price of $1,000 each. Okay, so now the selling price, meaning what they sold it for, is $1,000. Okay, so you've got these two different values to deal with. Okay, so just keep that in mind, cost versus price. Now, real quick, let's do a little review of things that we've already learned and how they apply in this situation. Okay, so Computer City makes their money by selling computer equipment. Okay, and that term making money is another word for net income or earnings, and the formula for net income or earnings or profit or making money is revenue minus expense. Okay? And as we learned back, I think in chapter 1, is revenue means the value received for providing goods and services to customers. And expense is the goods and services used up in the process of earning revenue. So now that we've reviewed all of those concepts, okay, what making money is, what revenue is, and what expense is, I want you to look at these $2 figures, okay, the cost of $600 and the price of $1,000, and identify which one of these is revenue and which one of these is an expense. So think about that, and I'll explain it in the next video.